Dave, good morning, Jack. Good morning, Ed Flowers, Submariner, J-Bone, UK Ray, Doji. The back's all right. We're not going to do anything significant yet. We've got 4 weeks of some intensive exercises, a lot of wall sits. Very excited. No. Erica Northport, good morning. Real quick, that's a lot. That's a lot of money for silver. If only some people had gotten together, I don't know, earlier this year and said, silver's going up. Silver, gold, all the metals continuing to run. We're going to break into why that's happening and why it's likely to continue. Team Palladium, we are holding up pretty well. It took us a while, but we're here. Here we are now. This whole thing started at 100. 65% move here on Palladium, but there's still time. Remember, there's the long-term chart we keep talking about, looking for that move back to around 220, 230. The news today, the real big news today before we get into anything, is the fact that the GDP report, which is filed by the Bureau for Economic Analysis, or whatever they want to call themselves these days, I don't even remember anymore, you can't get it on the internets. Look at that. Isn't that nice? Luckily, I know a guy. GDP numbers coming in. Real headline, 4.3% today. Real GDP growth. This is an acceleration from 3.8% in Q2 on the surface, looking like a gangbusters economic report, but the composition tells a different story. What's driving this GDP number that you can't see because, well, I don't know what's going on with their website. You got to go to the full release and the tables to get a little bit more insider information here. Consumer spending is the workhorse, about 2.4% percentage points of that. Healthcare and recreational goods, particularly information processing equipment, led the way. Prescription drug spending, also jumping. Net exports, roughly 1.6 percentage points of GDP. And this is where it gets interesting from a liquidity trade flow perspective. Government spending adding positively. Both the federal defense and state local consumption contributing. Investment was actually a drag on this report. That's pretty interesting. Private inventory drawdowns, wholesale trade, and manufacturing pulling it down. So what's interesting and what is not? Real quick. First, inflation picking up. The PCE jumping to 2.8 from 2.1. Core PCE going up. So if you have a hot GDP growth and inflation at the same time, the Fed does not want that. That puts stress on the possibility of a rate cut coming in January. So we're going to actually be looking for the odds in January to be declining, and it has been declining. That is problematic, and now the big question is what happens in March. Odds of 2 rate cuts falling, odds effectively under 50% that we have at least 1 rate cut through that month. GDP and GDI. GDI came in at 2.4 versus GDP of 4.3. These should match, but they don't. So the average of the two is 3.4%, which is probably closer to reality. That signals measurement problems and revisions coming in the future. So don't take a whole lot of faith in this number. Imports have collapsed, 4.7% annualized. Given the tariff issues and front-running behavior we saw earlier this year, that is a notable reversal. Investment turning negative. Businesses are pulling back. Residential investment is down 5%. Structure investment down 6%. Inventory liquidation showing that companies are cautious. Corporate profits absolutely running. $166 billion in profits from current production. Settlements, the BEA flagged 2 major settlements recorded a huge jump in health insurance claims costs for antitrust violations and e-commerce company for deceptive enrollment practices. The second one's almost Amazon pretty much over Prime auto enrollment and the government shutdown delay. So key thing here, composition here fits our framework, the way that we look at the world. Consumer spending's holding up because of healthcare and prescription drugs. The government spending contribution is steady. Corporate profits are surging. Even as investment declines, we are kind of in a late stage cycle of this market. Very important. All right. Everybody's going to the moon. Everybody's saying it's going to crash. And I'm just the dog in the boat going, what do you want from me? One dog goes one way, one dog goes the other. This guy goes, hey, what do you want from me? That's me. I'm that guy. I don't care. I don't care if it goes to the moon. I don't care if it goes down. The only thing that I care about is the signal and whether or not it's green or red. And right now it's green. Every day we get up, we analyze the number of stocks in the S&P 500, all the stocks in the Russell 2000, all the stocks in the NASDAQ. We analyze the numbers on the outside of the bell curve. You take all the stocks, you put all their performances through multivariate discriminant analysis, and you come up with numbers of stocks breaking out, number of stocks breaking down. Take the number of stocks breaking out, deduct the number of stocks breaking down, and you get a number. And when that number goes positive, we're green. And when that number is negative, we're red. And nearly every time that it is red, it's because there is a liquidity event happening. That's pretty much it. And we are out in front of every single one of those because that anomaly, the extremes of that bell curve, are what tell us when it's time to get out of the way and when it's time to take a shot and to start being bullish again. And if you need evidence of this, well, let's go back to the wave speech. Ooh, very exciting. Well, here is our... There you go. There's our track record for 2022 through 2024, late 2024. I got to update this. But as you can see, the market doesn't peak and drop at the very peaks, right? See that red line? See those hands? Yeah, that's because when markets sell off, they follow a pattern. They dip, you get a squeeze, and you get a dump. That's exactly what happened in January, or forgive me, what happened in April and March of this year. If we look at the SPY, we went negative earlier this year on February 21st with our equation. We hit this point right here in March. We called the squeeze because there was no buying pressure. We squeezed back up to the 20-day moving average, and we dumped. And you can go back through history, and you will see this pattern pretty consistently. That's the Nikkei crash. We had this happen back here in 2023. We had it happen back here in COVID. If you remember COVID, I sure do, because I had it twice. Down, pop, drop. This is basically the way that every single crisis has gone on in liquidity since 1987. So we're always paying close attention to it, but right now we are green. We're green. And the Russell 2000 is improving. Now, what are the big stories for this week? Well, here's the issue. As we head into the Christmas break, I want to just simply note very easily as you look at this, there are 4 things that I need you to really understand in the next week and a half as we head into 2026. The first thing is Japan is not going away. Japan is and has been for the last 13 months the single most important story in all the financial system. But we don't pay attention to it because it's far away. It's a little tiny island, way, way off in the Pacific, very, very far away from us, so we don't pay attention to it, even though its central bank has been the primary source of the bulk of liquidity that has driven the bull market for the last 20 to 30 years. That said, the Japanese central bank is going to be raising its interest rates. And because it's raising its interest rates, the carry trade that has carried this market, where people are able to borrow cheap and then take money over here to the United States and then arbitrage, well, higher interest rates is going to impact that liquidity. The Federal Reserve is going to tell you that they are engaging in reserve management support. But the bulk of the challenges go back to last August when the Nikkei crashed and everybody stopped talking about it. Okay. Why does all of that matter? The yen has been the world's primary funding currency. Stronger yen tightens global liquidity via the carry trades, and there is a very strong relationship between the weakness of the yen in the last year and the performance of silver and gold. It is very disturbing how close it is. So that said, what I need you to really be focusing on is what will happen in the event that money leaves the United States and goes home. It's not going to happen all at once, but it'll happen gradually and then suddenly. And that is the big risk for 2026. It is the onset start of global capital, cross-border flows that have been here in the United States going home. And if that happens, it leads to the valuation compression that a lot of people should be concerned about. Because if a lot of that money leaves, all of a sudden what will happen is leverage funds will start to reduce their exposure, and passive funds, basically those thousands of ETFs. Just to remind you, what is passive investing? Exchange traded funds, mutual funds, money that goes into a fund. They don't care what the valuations are because the money managers are just collecting fees. They really don't care about performance so long as they are tracking the S&P 500, which is their benchmark. They don't care. There are 4,800 ETFs in the United States today. There are only 4,200 stocks. One more time for everybody in the back. There are 4,800 ETFs in the United States. There are only 4,200 tradable U.S. equities. We are just repackaging our stocks. That large amount of ETFs helps hold up the valuations of those equities. But when foreign money leaves, the passive investing may have to dump some of those stocks, and that can lead to the valuation compression that it's defined, that valuation that has defined this market since 2022. Keep an eye on the yen. It's very important. Very important. So important, actually. So the very first thing to understand, big story, number one, is the strong yen means tighter liquidity. Okay, that brings us to number two, gold and silver confirming the macro stress. Cat's out of the bag. Okay, so the cat's out of the bag. This is a revolt against fiat currency. It's a revolt against the yen. It's a revolt against the dollar. Real rates are dropping. And the U.S. government and the U.S. Federal Reserve, forgive me, is engaging, well, the Treasury too, is engaging in fiscal repression. It took us 2 years to get to this point. I started writing about this like a psychopath back in October of 2023. And I said, choose your fighter. Choose your fighter for fiscal repression. I think I put up all of the characters that are in Mortal Kombat, and then I just added Jerome Powell. Because his finishing move is just basically dumping money on top of you. That's basically how the Fed really operates. Let's find that picture. It's got to be here somewhere. Oh, there it is. Good. Got it. Nailed it. All right, here we go. Hee. Boom. All right. What they're doing is they are going out to the front end of the curve and buying short-term Treasury bills. That keeps the front end of the Treasury curve in line. That effectively pushes demand to the back of the curve. So I'm not going to buy short-duration bills if I can't generate, this sizable return that I would anticipate, 4.5%, 5%, which we weren't far from too long ago. Well, what that is going to do now is hopefully lead to more buying at the 3-year, 7-year, 10-year level. No guarantee. But gold and silver just continue to run. And people keep asking, well, how much further can it run? I don't know. I don't care. I was telling everybody to buy it at 25. So now with silver moving the way it is, people say, well, what do I do? What do I do? What do I do? I keep saying the same thing over and over again. You don't have to chase it to the upside. You could sell spreads down here on stocks and equities in the gold and silver space. And if you get assigned, you get assigned. You're not chasing to the upside if it pulls back. But if you're selling spreads down here and it keeps going higher, you're making money because the value of the spread you sold goes down and you could buy it back for cheaper, or you let it expire worthless. This is going to be part of the strategy that we are laying out today at 9:10 on how to trade insider buying. Real quick, again, we talked about the GDP, PCE, durable goods, last major macro gate before the year-ending positioning locks. We're going to see how the market reacts to this today. It is definitely one of those days where there could be some strong positioning because tomorrow we have a short day. Probably a lot of people shutting their computers down today by the end of the day. volume weighted average price will be a critical tool for you to use today for day trading. Finally, energy in Venezuela. I would be remiss if I don't bring this up. Look, there's a lot of speculation about what's going to happen in the future with the United States and Venezuela. This is absolutely going to destroy the Cuban economy, what's left of it. Cuba running basically on cheap, almost free oil from Venezuela. This blockade shuts that off. We don't know what this is going to look like, but obviously this is going to ramp up in terms of a international story for the next 2 to 3 weeks, particularly if economic conditions continue to deteriorate in Cuba. You're going to hear Europe talking about it. You're going to hear the West talking about it. You're going to hear Canada talking about it. It's going to be a lot of noise. There's no trade on it. Or is there? Well, this is still around. I'm just going to point this out. This is the Hertzfeld Credit Income Fund, and this is a fund that exists in the event that the Castro regime, or what is left of it, and its family goes away. It is a fund that would benefit if Cuba actually liberalized. Just going to point that out. This is a fund, closed-end fund, that trades at a monstrous discount to its net asset value. I haven't seen, it might not even be a closed-end fund anymore. It might just be a straight-up ETF. But yes, I want you to keep an eye on this, because if this actually moves, it's telling you something about geopolitics that isn't going to be in the cards in any of the stories. So keeping a close eye on this, simply because it is price telling you the geopolitical story and the possibility of regime change, or who knows what, as we continue to follow the story. On the energy side, I am not speculating too much on WTI, and I am definitely not speculating in the refinery space. I am still concerned about some of the refineries that are down in the Gulf Coast that may need to go and source new crude for the purposes of refining. Remember, our refinery network is the one that really can handle that heavy crude, high sulfur content. So where is my focus? It stays in the pipeline space. It stays in the EMOs and the energy transfers and those types of names, because remember, wherever we're getting the crude from that it needs to be refined, it's got to go through pipelines. It's got to go through ships. It has to go through the midstream. All right. 903, Charlie, where are you? Everybody's got a little commentary. Take a bow on HYMC. We were in that at 250, or at least we were telling people how to get into HYMC at 250. Yeah, that's a good stock. It's just, again, Eric Sprott, which, by the way, we're going to highlight in our number 2 strategy for 2026. But let's start here. First off, I'm going to start with Real, largely because I can't believe this is actually a public company. This is basically it's like a high-end thrift shop. Ooh, we should have played that song in the morning. Macklemore's Thrift Shop. Now that's a song Don would absolutely love. And I have a jacket that I could wear while we do it. Maybe that'll be your Christmas gift, everybody. Tomorrow, maybe we'll change up the song tomorrow, and I will pull out the leopard print jacket. Yes, that is in my closet. You deserve that. Real. The squeeze is on, and it just keeps running. 717 forward PE, showcasing that value is dead. Real is just pure momentum right now. And so long as momentum remains positive in the consumer cyclical space, this is a name just to, I don't know, follow momentum, buy it, because here's the reason. Pretty simplistic. This is what is known as bounce lag. And this is where we go back and we look at a weekly or a monthly chart, and we look at all-time highs. We look at the liquidity cycle. We effectively say, all right, well, from its lows, back during that period where there was so much money sloshing around, this thing is like Carvana. What type of momentum flow could we potentially see? And on a weekly chart, coming back, it's literally in the 20s. And it's one of those stocks that you buy it, you hold it, and you set a 2% stop, or you set it back at the 20-day EMA. And you're just looking for a continuity of momentum. This is from Grant Henning. Grant Henning, the momentum trader. He wrote The Value and Momentum Investor in 2009. Also wrote the great book called Trading Stocks by the Numbers. Highly recommend both of those books. Grant Henning. And bounce lag is one of the strategies that he focuses on. He's constantly looking at stocks near their all-time highs or within their 52-week highs and just looking for that continuation of trend. TPL keeps coming back up, and a lot of people don't want to touch this. I'm just going to remind you, this was a stock that we were very heavy in back in 2022 when we were doing something on M&A activity in the Permian Basin. It has pulled back pretty significantly because, well, there was a lot of speculation. There was also a lot of insider buying around this stock at the time. Here's the thing about TPL, and I want to point this out. It's not just now about the ability to buy for pulling oil out of the ground. This is becoming an AI data center play. Land is cheap. Land can be converted, methane convertibility into these AI data centers to power them. TPL is a great long-term buy. It is going to get beaten up because so much money has been flowing into the stuff that people aren't paying attention to. But in a world where we are continually dominated by this idea that gold, silver, all the hard metals moving higher, they're not making more land. Just going to point that out. TPL is a good long-term play. I am going to pick up a couple of shares as this is bouncing around. HIMX as well. This is in the semiconductor space. This is a great little momentum stock. It has bounced around. It continually delivers these nice moves when we get down into oversold territory. Just going to remind you, this is very reminiscent. This stock is very reminiscent of Friedman, something that I traded back in 2022. It would fall to 6. I would buy it. It would pop back to 10. I would sell it. It would roll back over. It's done this a couple of times. I just want to bring this to your attention because this is going to be one of the top stocks to be trading in 2026. Target 5N whoever, whatever. What do you do? Who cares? What do you do? 5-9. Get out of my house. I don't even want to look at you. TGT. No, I got other things to do today. Target. Okay. Target, kind of a little bit of a pop, a little bit of a breakdown. Back under this level right here, 100. Consumer defensives are under pressure. And it might not be, look, we can focus on this because of the retail side. The consumer defensive stocks are just not waking up right now. And that's because when the Federal Reserve prints and when Japan prints, high beta does well. As we head into 2026, I'm going to tell you what that is in a moment. It's a year. No, what the actual trade is. Target, I'm looking for continuation down here. I would like to see the stock just get to oversold for another squeeze higher. But right now, I'm looking for a move back down toward 94. NBC, what do you do? Sounds like a bank. It's not. It's a consumer cyclical furnishing space. I don't know what to do with this. What? Well, here's your problem. There's your MACD, rollover, weakness, MFI, breakdown here. Yeah, I like this to the downside. I don't really know if there's much of an options chain for this. Ugh. Just pops on the screener. What do you do? What do you say you do? Zero. There's no volume on this option chain. It's terrible. It's awful. Terrible. It's terrible. Anyway, don't buy Masterbrand. Do something else. Novo Nordisk. It's going to create a pill that's going to make us all thinner. Or at least it has already. 8% oral pill. First oral GLP for weight loss, broadening its obesity franchise. Can't wait to see what it does to the liver. This is if you put this image into a Christmas tree, it looks beautiful. I will tell you that. Let's see. Do I have that? Let's see. Let's see. Nope, that didn't pop up. Huh. Anyway, if you put this chart into a Christmas tree, it looks lovely. Just absolutely, just tinsel all around. Look, you're going to be focusing on this. Momentum's going to come pretty heavy on this. The stock is obviously and shockingly not shorted, but this is the first catalyst that we have seen in a while. The question is, why haven't the insiders bought any of the stock? That's what I don't really understand, but we're going to dig into that in a moment. Novo Nordisk, I think what I like about this the most, you've gotten all the way back down to these lows in 2023. Just sell spreads to the downside. Just sell spreads to the downside. This thing's going to absolutely dominate outlooks for 2026. I will be digging into a lot of those over the next 24 hours. I bet that 25 to 30% of reports for 2026 mention biotech, healthcare, and GLP-1s and mention NVO. So sell to the downside. Not bad. That way you don't have to try to chase it. Maybe this becomes a sell the news event today, right? People taking profits from an 8% return. But this is the type of catalyst the stock has been looking at. Rocket Lab and SOC, I don't know what's going on here. I don't really care. Rocket Lab, that doesn't, who cares? Somebody shot something into space. It's Tuesday to me. Sable Offshore, not good. This stock's actually finally waking back up. It'd be hilarious if this stock actually took off finally. There was a lot of hype around this stock to start the year, and it didn't go well. But a little bit of a catalyst here. Approval for the Las Flores pipeline restart sparked pre-market surge. I sound like Alec Baldwin trying to do a Hispanic accent. I'm not buying this. I'm just not. I don't care. But pay attention to it. If it gets back to 10, it probably becomes a buy, and it actually has pretty significant upside. All right, let me get back to what I was going to talk about. All right. Eric is Dr. Eric. He knows. All right, 7 minutes. Here's your option. Here's your number two. Number two strategy. Yesterday we talked about F-score, Graham score, high-quality stocks. We're going to be doing that today, 3 o'clock, last hour. I'm going to do half an hour on F and G score stocks, Z score stocks, focusing on a lot of the other metrics. I want to talk about insider buying real quick. Okay, because this is literally the easiest thing in the world. I don't know why more people don't do it. I don't care. Because the fewer people that do it, the more it means that I get to, and it's mine. This is the thing that I like and care about the most in all the equity markets. And I know that some people go, what are you doing? Who cares? I'm fascinated with what rich people do with their money. I just find it interesting. Because once again, the rich people in America are the only people who have money. Am I wrong? 10% of the United States drives 50% of the economy. So when that top 2-3% actually does something, I pay attention to it because it's a lot of money sloshing around. I'm always watching what executives are doing with their money. And I'm not just watching what they're doing with stock rewards. I'm watching when they actually put their money down on the table. They're putting their money down on the table. And again, Peter Lynch said, if insiders might sell their shares for any number of reasons, but they buy them for only one, they think the stock is going up. So how do you exploit this? How do you actually focus on this? Let's just start with the very beginning. Insider buying refers to stock purchases made by company executives, directors, and large owners. CEO, CFO, CMO, CIO, board of directors. Or think about a company like Berkshire Hathaway, which buys $30, $40 million of Occidental at a time. Okay? These transactions are disclosed via SEC Form 4 documents. SEC Form 4 documents are pretty simple. Basically, an executive buys the stock, and it looks like this. Here's the name of the person who bought it. Here's the issuer. Here is whether or not the purchase was direct or indirect. I don't care about indirect purchases. I care about direct. D, the D form, because that is a sign that the executive is actually putting their money down. They pulled it out of their brokerage account and they bought their own stock. Huge difference between direct and indirect. So when we look at, purchases across the market, and I'm going through all this stuff every single day, I am explicitly ignoring what the direct is doing. Executives will buy for any one particular reason. They believe shares are undervalued and that the prospects are improving. There's 5 different reasons why they might buy, 5 different types of purchasing, but for them, every single one of them is tied to undervalued and being a stronger prospects in the future. Unlike analysts, insiders act with real money and legal accountability. The difference between direct and indirect. Direct buying, executives purchase shares outright in the open market. They're going into their brokerage, they're taking their own money out, and they're buying it. Indirect is done through trusts, funds, or compensation vehicles. Direct purchases signal conviction and personal risk. The CEO is already compensated by the company. They're already compensated in stock usually, so they're buying more of it. Okay? Markets respond far more positively to direct insider buying. So what are we doing? Right? What's the preferred trade on this? There's 3 or 4 different ways that I like to trade insider buying, but the primary one is credit spreads. And the reason's pretty simple. If the CEO or the CFO are buying the stock at 40, or Occidental is being purchased at $40 by Berkshire Hathaway at $40, I look to sell a spread under that level. Because if the executive likes the stock at 40, I'll like it a lot more at 37.50 if I got delivered the stock at that level and I want the stock. Now, I don't necessarily always want the stock, but I am looking to take advantage of the anomaly that is associated with insider buying. The anomaly within insider buying is that the performance of the stocks tend to do extraordinarily well in the first 30 days. That's where the bulk of the alpha is generated. It usually comes in the first 48 hours of announcement. So what we look to do is sell a spread. You sell a put below where that executive bought the stock, and you buy a put the next tick down. And what are we looking for? We're looking to collect premium up front and define the risk at entry. The trade profits if the stock stays above that chosen level, and if the stock takes off, and we were talking about HYMC momentarily ago, you know that we have been selling spreads on HYMC over and over and over again, literally since the stock was at 4. Okay? Yeah, we didn't buy it at 4 and go into it at 26. Some people actually got assigned it, but the point here is you keep doing this over and over again. How do you know when they sell the stock you bought, and what do you do then? If the executive can't sell the stock for 6 months, I have a 6-month window. And they can't sell in their blackout windows either, which is right around earnings. So if an executive's buying the stock or a company's buying the stock, it's a long-term purchase, and you got at least 6 months to play with. Our approach is about monetizing time, volatility, and positioning. And what we do is we combine our momentum screen, right, our momentum reading that we talk about each day. If momentum is negative, the markets are breaking down because of volatility concerns or liquidity concerns, we now look at some of these numbers and we say, all right, we know there's a line in the sand where the executive bought the stock. The stock could continue to fall further, but we know that if momentum returns back, if the stock falls to 8 when momentum is negative, and then the Fed steps in and we get some support from the Fed and other places around the world, but the executive bought the stock at 13, we're going to want to buy that stock at 8. So it's about timing. It's about the mechanisms of utilizing what the market's giving you. You're looking for spreads that are tight. You want to make sure that you're focusing on highly liquid stocks, highly liquid options chains. But you're always looking to do a couple of things, right? Selling credit spreads below where the executives bought, insiders defining that real-world reference for value. The price staying above insider levels increases probability of profit, and we get paid while insiders wait for upside. This is the last chart. Positive momentum environments lift quality stocks. So once again, if the stocks move higher, the value of the credit that we sold goes down. That means we can buy it back. We're looking to capture 65 to 70% of our credit spread within 2 weeks. Buy it back and move on. Rising equities increase the value of those sold spreads. Our target for those trades, 16 to 20% return on investment per trade, 80% probability of profit, and compounding into 100% annualized returns with repetition. We did this with Occidental for about a year and a half. We did Occidental, I think, 11 times. Occidental hit the first 10. The last time, it didn't. And we have been managing that position since. We had an opening position somewhere around like $49. We have been selling calls out of the money, and we have driven our cost basis down to about 42. Just keep collecting capital and keep managing that position. That can take time, and it can be a little bit frustrating. But once again, it's a stock we wanted to own because Warren Buffett has hundreds of billions of dollars in this stock, or tens of billions of dollars. We got to be over 100 by now. Anyway, that's the point. That's what we're going to dive into later today at 3 o'clock. We're going to do our first half hour on that quality and value. We'll do our next half hour on education around this strategy. We'll have a new strategy tomorrow. We'll have another one on Friday, and then Friday at the close, we'll do another half hour on the next two, number 3 and 4, and then through the end of the week. Again, we will be talking about next week. We'll be doing a little bit more forecasting focus next year. Again, heavy macro, big focus on Japan, big focus on the U.S. and the Federal Reserve. We got to take everything a quarter at a time. For right now, continue to take what the market is giving you and enjoy your trading day. Don is coming up momentarily. I will be back later today at 3 o'clock. I hope that everybody has a great trading day. Catch up with you on the other side.